So you have an emergency and need money. Should you take a personal loan or dip into your savings? If you take a personal loan, your cost will include the interest you need to pay plus processing charges. If you dip into your savings, on the other hand, your cost comes in the form of returns foregone, plus the penalty for breaking an investment midway. Let's weigh the costs of each. A personal loan is usually expensive due to high interest rates, which currently fall between 12.5 and 21%. The interest rate that you ultimately get depends on what you earn, your credit history, and where you work. If you work for a big brand name company, you may get a lower rate than if you're self-employed. The world is unfair and personal loan rates are no different. The more you earn, the lower your personal loan interest rate is. If you earn more than rupees 75,000 per month, you may get a loan with about 14.25 to 15.5%. If you earn less than rupees 35,000 per month, the same bank may now charge you 18 to 21% on interest. Finally, you'll have to add a 2 to 3% processing fee to the total loan amount. But what if you dipped into your savings to pay for this emergency instead? Remember, when you dip into your savings, you're giving up the potential to earn, and the percent you earn depends on the type of investment. Let's look at 3 types: a fixed deposit, a bond fund, and an equity fund. If your savings are in a fixed deposit, then you're earning between 8.75 and 10%. If you break the fixed deposit, you'll not only forego at least 8.75% in potential earnings, but you'll also have to pay a 1% penalty. Since you would have paid an interest of at least 14.25% plus processing charges, it's better to break your fixed deposit and pass on the loan. Let's say your savings are in a bond fund. If your savings are in a bond fund, you're earning between 8.75 and 10%. Again, break the fund and avoid the loan. Your losses would be less than the cost of a loan with at least 14% interest. Finally, what if your savings are in an equity fund? Long-term returns on equity funds have the potential to beat the 14% cost of the loan. Since inception till date, the Sensex has given a 17% annual return. In this case, keep the fund and take the loan. Pay it back diligently, and next time, create a fund for emergencies only.